Most traders know that the Forex market doesn't move in a straight line. It goes through different market cycles, trending, ranging, consolidating, or breaking out. But what if I told you that one of the biggest reasons traders fail is because they're using the same strategy across all cycles? That's like wearing a winter coat to the beach. Just doesn't make sense. Today, let's break down some of the best Forex trading strategies for different market cycles and how understanding these phases can give you a serious edge. Let's start with trending markets. This is when price is clearly moving in one direction, either up or down. In these conditions, momentum-based strategies thrive. Think moving average crossovers, breakout pullbacks, or even riding the wave with trend-following indicators like the MACD or ADX. When you see higher highs and higher lows in an uptrend, or lower lows and lower highs in a downtrend, you want to ride that train. This is where the profit ladder strategy can be incredibly powerful. It lets you scale into the trend, stacking profits as momentum continues. But remember, no trend lasts forever, so always keep your risk in check. Then there are ranging markets. This is when price bounces between support and resistance without a clear direction. It's quieter, but that doesn't mean you can't profit. In fact, range-bound strategies can be some of the most consistent, especially if you know how to spot clean levels. Oscillators like RSI and stochastic are your best friends here. They tell you when the market's overbought or oversold, giving you precise entry and exit points. A grid-based strategy also works well in ranging markets, opening buy and sell positions at different levels to catch those repeated bounces. This is where strategies like the grid matrix or recovery ranger shine. But be careful. If the range breaks and you're not ready, it could wipe out your gains. Next, let's talk about breakouts. These usually happen after consolidation phases or before big news events. It's when the market builds up energy and then bursts out in one direction. For breakout traders, timing and confirmation are everything. You can't just jump in at the first sign of a move. You need volume, a clear candle close beyond the key level, and ideally a bit of confluence from other indicators. The trend breakout strategy is built for this. It anticipates these surges and positions you ahead of time so you're not left chasing the move. Now here's where most traders mess up. They don't adapt. They find one strategy that works during a trending market, then get confused when it stops working during a ranging cycle. What you need is flexibility, and that's why I recommend using a system that can adapt with the market. One tool that does this exceptionally well is the Trading Management Solutions EA by TakePropips. It's not just an expert advisor. It's a complete trading toolkit that recognizes market conditions and adjusts its strategy accordingly. For example, when the market is ranging, it can switch to a recovery-based or hedging strategy. When it detects a strong trend, it can use profit ladders or trend follower. You're not stuck trying to guess what the market's doing. It does the heavy lifting. Plus, it comes with features like an AI-powered trend scanner, currency strength meter, and a dashboard that lets you manage trades with one click. Whether you trade manually or want full automation, it adapts to your style. Another underrated market phase is the transition phase, when the market is shifting from ranging to trending or vice versa. This is where a lot of signals can get choppy. Instead of jumping in right away, look for confirmation. You might see a range get tighter and tighter, volumes start to pick up, and then boom, price explodes out. Using a tool that can detect these early signs, like the AI market detector within the TakePropips system, helps you position yourself before everyone else. At the end of the day, it's all about alignment. You want your strategy to match the market environment. There's no one-size-fits-all in Forex. Some days, it's better to be aggressive. Other times, you need to sit on your hands and wait. The key is knowing what phase the market is in and having a strategy that fits. If you've been struggling with inconsistent results, it's probably not because you're a bad trader. It's because your strategy isn't aligned with the market cycle. Start analyzing the market phase first, then choose the right strategy for the job. Whether it's trend following, range trading, breakouts, or a combination of all three, have a plan for each. And if you want a system that simplifies all of this, check out the Trading Management Solutions EA by TakePropips. It's built to help you trade smarter, not harder, no matter what the market throws at you.